A bit of an off day yesterday, but January starting strong, and it's known to be a strong month for stocks. It's called the January effect, and we're exploring the factors that make this month an ideal time for investors and whether it will be another opportune trend for this year. Here to talk about it is George Athanassakos, the professor of finance at the Ivey Business School at Western University in Ontario. And Professor, thank you very much for joining us.
Well, thank you for having me.
Okay, first question. Is the January effect still an effect? Does it exist still?
It exists. It's an average effect. It doesn't work every year. It works on average. Let me just put this in the context. I'm a value investor. As value investors, we believe that price and value are not the same. And the question is, what makes price different from value? There are two things. One is human nature. Humans are not rational. They have many weaknesses. They herd, they extrapolate, they are over-pessimistic, they panic, they get greedy. But the other one I want to talk about more is professional biases. Professionals, driven by self-interest, they trade throughout the year in a way that affects stock prices throughout the year and make the price deviate from value even within a year. So professionals want to maximize the take-home pay, which is basically salary and bonus. And the bonus can be very big. So in January, they say, because they have one annual remuneration cycle. So in January, they say, what should I do to secure my bonus at Christmas? They know from school that the higher the risk, the higher the return. So in January, they say, let me get out of safe positions and go into riskier positions that is riskier than the benchmark. So the herd in January goes towards riskier stocks, and they drive them up. If you look at the chart of stock returns, the January returns are very strong.
Yeah.
Now, throughout the year, as they realize the Christmas given bonus return, they slowly get out of the riskier positions and go back to safer positions.
So essentially, it's inevitable. Like the market creates this cycle.
So the rebalancing they do, but they're not stupid, right? They don't go blindly in the stock market every year. That's why I say this is an average effect. All depends on how the professionals feel the year is going to unfold. If they believe the year ahead is going to be a bull market, they go heavily into risky stocks. If they think the market next year will be weak, they avoid riskier securities. And so what we observe is when the market is strong, we have a very strong January effect, but on average about 7% a monthly return. When the year is weak, you have a negative January effect. So it all depends, I guess, this year, what the professionals will do. If they are positive about the year, then we're going to have a strong January effect. If not,
we're going to go
be a weak effect.
Professor Rebecca wants to jump in and ask a question.
I'm just curious. Do you think central bank policy has, changed these effects? Because I feel like the market's been very reliant or have been focusing more on, is the central bank going to cut again? And the market's been reacting more on policy than it has been on some of these, nuances and effects.
Definitely. And what the government does affects the shape of the yield curve. And my research shows that whenever the yield curve is positively sloped, that is, the short rates are way below the long rates, this is positive for the markets. And we normally observe strong Januaries when the yield curve is positive and when expectations about profits are increasing. So this year, from what I see, we have a slightly positive yield curve and slightly positive expectations about profits. So this is positive for the January effect. But again, these are not very strong indications. Again, it goes back to institutions, to professionals. how they view this. Do they view this as a positive for the markets or negative?
What about, we've seen more and more retail investors coming in. Are they starting to have a similar impact to the institutional investors?
Well, we've seen the last couple of years, what drives the market is primarily retail investors. Most of the professionals seem to stay on the line, on the side. And this is another big risk because retail investors are up to here in margin debt, and they're not very good in market timing. They are the worst market timers. Historically, whenever retail investors go heavily into equities, this is a negative effect, a negative sign. Mm-hmm. The market's probably reaching at the peak. Because, again, if you look at the evidence, there was a study by BlackRock, and they found that on average, the last 40 years, equities return about 8%, mutual funds. And then they look at the individuals who hold these mutual funds. And the individuals, even though the fund made 8%, the individuals made 2%. Okay. And the question is, how is this possible? Well, it is possible because humans, based on the weakness of human nature, they tend to buy at the peaks and sell at the bottoms. They panic at the bottoms, they're panic stricken at the bottoms, exuberant at the top. And if you do this, you're never going to have good performance.
All right, we're going to have to wrap it up there, Professor, but thank you very much for joining us this morning.
You're welcome. Bye-bye.
That is Professor George Athanassakos. He's a professor of finance at the Ivey Business School.